Hey everyone, this is Clayton with Your Arc Insurance Agency, and I'm back with another video. I hope you're enjoying this type of style of video where I kind of do a PowerPoint presentation. If you don't like it, just let me know. Put a comment down below. But if you do like this, give me a thumbs up or say, yeah, Clayton, keep this up. And I'll keep bringing the content via this way. Like I mentioned earlier, I'm a visual learner, so I learn, by seeing things visually. And so hopefully you guys are, most of you are the same way, or some of you are the same way. And I hope you enjoyed this style of video. So in this video, I wanted to talk about how does homeowners insurance work and what you need to know about homeowners insurance. And so first, I'll go over some of the two common types of homeowners insurance, and then I'll go over the different coverages based on the different types of properties that a lot of the people buy in regards to covering their home. All right. So the first one is actual cash value versus replacement cost policies. So actual cash value basically looks at the replacement cost minus the depreciation, right? So perfect example, let's say maybe 5-10 years ago, you spent a bunch of money redoing a kitchen, or maybe you have that, suite set up with your movie theater and all that kind of stuff. And you spent, a lot of money at that time to have your, media room set up and everything like that. But that was about 5 or 10 years ago, right? So if you have a actual cash value policy, it basically, God forbid if there was a fire or something like that, or there was a flood and, your media room got damaged, or maybe your kitchen got destroyed, what an actual cash value policy will look at the replacement cost minus the depreciation. So let's say, over the span of that 5 or 10 year period, the actual value of the kitchen or the actual value of that media room, diminish 10% or 20%, right? So it's that policy might only pay up to 80% of whatever that value of that kitchen was, or whatever the value of that media room was, right? So let's say you maybe spent 10 grand on that kitchen or 10 grand on that media room, right? Well, the insurance company might only give you a check of 8 grand if it diminished 20%, or it might even give you 5 grand if it diminished less than that. So it really just all depends. But, actual cash value policy, I really don't recommend that. I really recommend one of the other policies, which is the replacement cost policies, and we'll go over that in a second. So what is the replacement cost policy? It basically helps to pay, repair, or replace damaged property without deducting for depreciation. So basically, it's a little bit more fairer, I guess, in some ways, if you want to say that, versus the actual cash value. It's not going to look at the depreciation of that kitchen or the depreciation of that media room. It's going to basically pay a set amount of how much that kitchen might have placed, or might have to replace the kitchen or to replace the media room. This would also cover not just the actual kitchen or just the media room, but it could also cover like personal belongings. So let's say you might have had a painting in that media room or something like that, and it also got damaged. It could also cover that too as well. So as you can see, the replacement cost policy is a little bit better than the actual cost value, especially they're not going to factor in depreciation as they do with actual cash value policy. So how much does homeowners insurance cost? So unfortunately, it's not a one size fits all when it comes to the price of homeowners insurance. I did go to bankrate.com, which is a really good site, which has tons of financial information. So one of the, what they averaged on terms of average homeowners insurance, you're going to be looking around $1,300 a year for your homeowners insurance. And so that's for a $250,000 property. And so again, this is just national average. I know, especially here in the Northern Virginia area, DC metro area, 250,000, you're not going to find a whole lot of properties at that rate. But there are some out there, but on average, you'd be looking around 1,300. So, if your property is maybe around 500 grand, you might be looking around 2,600. But again, like I said, there's other variables that play when determining how much your homeowner's insurance is going to cost. Things like having a pool, things like, just other variables that can come into play, the zip code that you live in, Just there's so many things that come into play when determining how much homeowners insurance is going to cost you. So unfortunately, it's not a one size fits all situation, but on average, this is what you can kind of expect to pay for homeowners insurance, roughly around $1,300. Again, the higher the value, the home, obviously, the more expensive the homeowners insurance can be. And so, like, this is just to, give you an estimate of how much you could be looking at depending on where you live. And again, other areas like, especially like California and stuff like that, especially in areas where they might have a lot of like natural disasters and stuff like that, that can also play a role in having a little bit more expensive homeowners insurance, because you also have to, incorporate those high risk or those variables which can raise your homeowners insurance. So there's about 8 types of different homeowners insurance coverages based on properties. I didn't want to cover all 8. So what I did was I kind of narrowed it down to some of the most common ones. So there's a HO3 policy, an HO4, HO5, HO6, and the DP3 policy, which I'll go over in a second. So HO3 is kind of like your standard, base, homeowners insurance policy for an owner occupied home. So an owner has to be living in that property. And basically it just covers some of the bare bones things that a homeowner would want to have covered in the event of like a fire or something like that. It's kind of like your bare bones policy. The HO4 is basically for your renter's policy. So, a lot of times renters, they try to skimp and they're trying to save money, and I get it. But, I highly, highly recommend that if you are renting, you definitely get an HO4 policy. They're typically relatively not that expensive. But a perfect example, it happened to a friend of mine. He was renting a condo. There was a fire in the kitchen of an individual who lived above him, and it caused the sprinkler system to go off. And the sprinkler system, all the water from the top, obviously because of gravity, comes down to the bottom. So a lot of his things were ruined in his condo that he was renting, and he didn't have a renter's insurance policy. And so by having a renter's insurance policy, not just protects like some of the valuables and things that you have in your renters, but you can also maybe help with like replacement costs. So if you need to maybe find another place to stay or live somewhere else short term while they do repairs on the rental property or in the apartment or wherever you live, by having a renter's policy, it can protect you in the event of something that's beyond your control. I mean, he had no control over what happens above him, right? Or even if the situation was reversed beneath him, right? And so, having that type of policy can protect you in the event of something that happens beyond your control. The HO5 policy basically is a little bit more broader policy. It's an open perils policy. So it gives you a little bit more coverage than the HO3. The HO3 for the most part is pretty fine. It's pretty standard. But, let's say you have like, a really expensive home, or you have a lot of, valuables and things like that in your home. Then, I would highly recommend doing the HO4. This is for kind of like your, multi-million-dollar homes and stuff like that. Highly recommend that. If you are adamant about, if let's say you had an HO3 policy and you're adamant about moving up to an HO5, I would just maybe compare the cost. And if you're comfortable with paying just a little bit more money, then I would highly recommend getting the HO5 policy. The HO6 policy, it basically covers condos and townhomes. It's basically a policy that's like it covers everything with inside the wall, right? Or inside your unit, right? So it's also called a walls in policy, where basically it covers anything inside your unit, anything inside your specific home. That would be covered. So like, let's say a pipe burst or something like that, or I'm trying to think of a situation, basically just anything that happened inside your unit. Typically, a lot of the condos associations, they'll have a separate policy for things on the exterior of your home. So like, let's say something happened to the roof or something happened to siding or something like that. That's on the exterior of the home. And so typically your HOA or typically your condo association, they may have a separate policy, and I would check with them too as well when you are buying. Check it to see your condo docs, or check to see with your realtor to see if they can ask to see what is covered on the exterior of the home versus the interior of the home. And so, but most of the time, and for individuals purchasing a condo or purchasing a townhome, they typically go with the HO6 policy. Now, let's say you are a landlord, right? Let's say you have multiple rental properties. Well, typically a DP3, which is also classified as a landlord policy, I highly recommend getting that because in the event that a tenant is hurt on your property and it was something that, again, it might be beyond your control, but like, let's say, there was faulty, like let's say with the property when it was built at the time, something was faulty with it and the ceiling came down, or, something was built improperly and the tenant wound up getting hurt. Well, you can be at fault if you are held, for negligence, if you're at fault for that individual getting hurt. So having a landlord policy protects the landlord, or even protects, like, not just you, but if you have let's say like you have the property under a business, it could protect your business, protect you from the tenant going after your business or going after your own personal assets if the individual gets hurt. And especially if they got severely hurt, they might have medical expenses, they might have rehab, they might have a long list of things that that happened to them, or that might need to happen in order for that individual to get back to where they were. And so having a landlord policy could protect you, your assets, and then obviously, just yourself, in the event that a landlord or in the event that a tenant got hurt on your property. So these are just some things that you might want to keep in mind, and just some tips that I've seen a lot over the past, year or so. And I highly recommend that you really just do your homework to figure out what's the best type of coverage for you at that specific time. And then what I also tell people too as well, like if your assets are accumulating, right? Let's say you add more things to your house, or you get more rental properties, or whatever the situation, it's always good just maybe, every 6 months or every year, just do an assessment of where you are, because you might need more coverage. Like, let's say if I go from 2 rental properties to 3 rental properties or 4 rental properties, I might need more coverage, right? Just to protect myself and to protect my business. And so just some things to think about. I hope you enjoyed this content. Let me know if you like this style of video, and I will definitely see you in the next one. Take care.